Right now, within the massive agrochemical sector Sharda Cropchem a clear valuation anomaly, yani mulyankan visangati, dikha raha hai. Here is the current reality of the stock. It sits at a market cap of 8,331 crore rupees, trading near 923 rupees, like a textbook perfect value stock. The decision we have to make is whether this is a genuine hidden gem or if their 100% outsourced business model is actually a hidden trap. To figure that out, we are going to tear down their asset-light structure, examine the moat built by their 3,000-plus product registrations, review who actually owns the shares, and weigh the specific risks to land on a definitive buy, hold, or sell verdict. The top-line numbers scream buy. But a model built entirely on external manufacturing requires heavy skepticism before you commit a single rupee of capital. Let's define their core strategy. Sharda's asset-light model, Kasida Madlab hai, they don't build factories, they build dossiers and registrations. Every single drop of their product is manufactured by third parties, predominantly in China and India. This flowchart maps their operating area. Their moat isn't chemical vats. It's capital deployed for 2,994 active product registrations across 80-plus countries. Avoiding massive manufacturing capex generates high returns. FY26 return on capital employed hit a landmark 30.4%. But that efficiency comes with a steep trade-off. Without control of their own factories, they are entirely at the mercy of global supply chain disruptions. We saw the exact cost of this vulnerability in FY24. When global raw material prices spiked, Sharda's operating profits plunged by 53.9% because they lacked the backward integration to absorb the shock. That 30% ROCE is the premium the market pays them for absorbing the severe supply-side risks that traditional chemical manufacturers avoid. Despite those supply constraints, the volume momentum is aggressive. In FY26, annual total income reached 5,373 crore rupees, representing year-over-year growth of nearly 23%. The final quarter of that year was particularly strong. Net profit jumped 56.5%, and revenue from operations grew by almost 13%. This chart gives us the 5-year context. Sharda has maintained a steady revenue compound annual growth rate of 15.5%. That sustained double-digit growth rate paired with a low valuation multiple is exactly why the PEG ratio sits at 0.1. Statistically, the stock is heavily discounted relative to its actual earnings power. To understand the discount, look at where the money comes from. Over 80% of their revenue is concentrated in Europe and the NAFTA region. Europe is currently revising its regulations, forcing an average 30% reduction in allowable pesticide concentrations. The market views this as a direct systemic threat to the viability of Sharda's existing library of dossiers. That 0.1 PEG ratio isn't a spreadsheet error. It is the exact price the market is assigning to the uncertainty of shifting European regulations. To survive that kind of regulatory threat, a company needs a flawless balance sheet. Sharda operates completely debt-free, holding 702 crore rupees in liquid cash and bank balances as of March 2026. This donut chart of their shareholding pattern reveals high internal conviction, with promoters holding a 74.82% stake. We also see institutional validation. Mutual funds and foreign portfolio investors hold nearly 14%. Carrying zero debt means Sharda is entirely insulated from the rising interest rates that crush highly leveraged competitors. The liquidity trade-off here is stark. With only about 8% of shares available to the general public, any slight change in institutional sentiment can trigger violent price swings for retail traders. This is a concentrated, high-conviction setup. The promoters and institutions own the vast majority of the risk, leaving very little float in the open market. Looking forward, management is projecting steady profitability, guiding for an EBITDA margin in the 17 to 18% range over the medium term. Maintaining that growth is expensive. They plan to spend 350 to 400 crore rupees every single year exclusively on new product registrations. This table highlights their next major strategic pivot. They are allocating a portion of their 1,068 pending applications toward biologicals and biostimulants, which command a 3 to 7% higher margin than conventional generics. They are actively targeting core agrochemical molecules, losing their patents across Europe and North America, aiming to capture market share with competitively priced generics. They are also expanding their in-market teams to sell directly to farmers, cutting out third-party distributors to keep more of the margin. The roadblock to these plans is the rising cost of European registrations. This will force CapEx spending higher in the near term and push out the timeline for a return on that investment. Sharda's growth story now depends entirely on execution. They have to convert those pending applications into high-margin biological sales faster than the regulators can move the goalposts. Let's pull the facts together. Sharda Cropchem is a zero-debt, high-return compounding machine with a massive regulatory moat, severely offset by its total dependence on Chinese and Indian manufacturing. This scorecard visualizes the tension. You have exceptional financial strength and a deep registration moat in the green, directly fighting the heavy red risk of a highly vulnerable supply chain. Here is the buy case. If you are a risk-tolerant value investor, the current 923 rupee level offers a reasonable accumulation zone, backed by management's realistic 15 to 18% growth guidance and cash-rich balance sheet. Here is the hold case. If you bought in the 500 to 600 range, hold your position. You don't abandon a company delivering 30% ROCE just because of near-term price volatility. And the sell case. If you are conservative and cannot stomach sudden margin drops caused by freight costs or potential China-Taiwan trade shocks, this asset-light model is too exposed for your portfolio. The math is clear, but the risk is real. Identify your risk profile and invest accordingly. Insight anchor se jurne ke liye tayemat.